more than just business news, we're news for business people.
Thanks for joining us on lunch. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Ira Dugal. Let's get to the headlines this Tuesday afternoon. Indian markets take a breather as investors gear up for the third quarter earnings season.
Coal India is the top gainer on the Nifty after the mining giant hikes coal prices for the first time in 18 months.
Tata Motors gains more than 2% in trade today after its subsidiary Jaguar Land Rover reports its best ever annual sales in 2017.
The Telecom Commission will meet today to try and finalize its recommendations on a relief package for the sector.
And Maharashtra allows construction on unused industrial sites across the state, including in Mumbai, to meet targets set under the Prime Minister's urban housing scheme.
Let's take a quick check at how the markets are faring this afternoon. Neeraj is here, as always, with some of those key takeaways. Neeraj.
Yeah, so a day of consolidation, you would reckon. Again, flat across the board, flat across volumes, no great volatility as well. I don't think India VIX has done too much either. But just specific pockets which are standing out in the session today. So if you just look at what's moving around, I think look at Coal India on the gaining side. And that stock is doing rather well for itself, up about 5.5 to 6%, maybe the price hike impact. So that is doing rather well for itself. What's gaining in trade selectively are banking names. So Yes Bank, Axis Bank, State Bank of India, I presume, was also amongst the gainers list a while back. So those set of stocks are doing reasonably okay for themselves. Very strong guidance by Subros. You would remember 2 days ago, the management came, spoke to us. The stock was up 20% post that. Today it's up another 16%. And I think just take away from that CV guidance that they gave. And real estate continues to have a selective move upward. So Oberoi, Sobha, a couple of others like Marathon having a good enough session. But more importantly, a clutch of other names are doing extremely well. The ones related to metals and mining. So Balasore Alloys up about 8.5%, Godari Power up about 2%, some Maithan Alloys and some of the others too. So a clutch of these small cap metal names, not the ones which are in the process of finding a buyer, but ones which are doing good work seem to be doing well in the session today.
All right, Neeraj, just stay with us now. You know, it's a day of consolidation, as Neeraj said, gives us an opportunity to step back, look at the bigger picture. A lot has been said about the global equity rally and the expensive asset prices to the extent that some have already called a bubble in financial markets. But renowned investor Jeremy Grantham seems to believe that the bubble is not large enough to burst, at least not yet. In his latest article, Bracing Yourself for a Possible Near-Term Melt Up, Grantham writes that the financial markets are in the melting up phase and that a meltdown is still some time away. Neeraj is here with some absolutely fabulously interesting charts. Neeraj.
Hey, thanks. So, you know, again, as I said in the morning, I think the one that stood out for me, the point that he made is this, that one, of course, the average market declines are faster, but the one point is that being late is not too different than being too early. I think this is the point that he makes very well by the example of the charts that will come up on your screen. So four bubbles, as he calls them, that he's brought out. The interesting part, each of these, the 1929 S&P 500 bubble, or the Japanese equity market bubble, or the 2000 bubble, which a lot of people are aware of, or for that matter, the housing bubble that almost everybody is aware of. The common time frame is about 3 years, 3.5 years. Now imagine what happens if you indeed called the bubble and got out of your investments at around these levels, wherein you actually called the bubble right, but you got out of the markets, and then you had to go through the pain of seeing the market move up, despite the fact that the markets were in bubble territory. and you are out of the market then, but your fellow asset managers, your fellow investors, the person you meet in the evening for a beer is saying that, hey, my stocks are moving up, but you are right, but you're out of the market. What do you do? So he makes this point that being too early is as painful as probably riding the wave, not calling the top, and then still experiencing the fall as well, because hey, you're only merely losing out on money that you've made already, instead of what you would not have made if you would have gotten out. So which is, I think, a very important point. Now he puts it into today's context by using the charts of S&P 500 and makes the point that, let's bring that up. This is the 3-year performance of S&P 500. We are currently at about 2747. According to his calculations, one, that we've made a big move in the last 6 months, which is swift, which is now smelling of the start of what could be a bubble zone. And for it to be confirmed, the markets have to move up to levels of 3400 to 3700 in the S&P 500 over a period of the next 9 to 12 odd months, so that in a period of 15 to 20 months, we have about a 60% move, because that's what the previous bubbles have been, around 50-60% move in a period of anywhere between 15 to 25 months. So if that were to happen, then we could probably be in a bubble, but that is not certain as yet. And just very lastly, I think something that both Ira and Menka liked a lot, but the 4 points that he made, the third point, Harsha, maybe you will like as well, but the 4 points which he makes, which bring about our indicators of bubble, rough indicators of bubble. One, increasing concentration in low quality or quality stocks and low beta stocks. Two, outperformance of low quality beta. Hey, just hang on. The third point is important. Equally bubbly other asset classes, and he draws the reference to the housing market. But he says that while on an absolute basis, the housing markets look like they are comfortably past the territory, if you compare it to 2007, the move today in certain markets in the US, New York, etc., is all dwarfed. He mentions in the article that previously you used to have conversations in Florida about how the seaside home that you bought has moved up 100%. That's not happening as yet, so we're probably not that bad. The fourth and the fifth point, interesting. The fourth point, wherein he mentions extreme expensiveness, again, something that we've probably seen that in certain pockets, but he makes a very important point that this is a necessary condition, but not a sufficient one. And the fifth one, right wing in power. What we've missed, what we've not put out here is in brackets he's mentioned just saying, and then he brings out the 4 points wherein the previous few times that the bubbles have happened, there have been a common similarity. Do we have that chart? I don't know if we have that graphic or no. But the 4 US presidents were all Republicans, and they were nice to some blokes. So, you know, who was nice to bankers in 1929? Nixon was nice to the Chinese. Bush was nice to Cheney, and Trump, as of now, seems like he's nice to the Russians. Could this be the common factor that could lead to a crash in 2019, to a pricking of the bubble in 2019? So this is the fifth common point between the previous instances and this that Grantham has thrown. And I quite frankly loved this one the most, but I thought he made a very compelling argument in the first one. Don't get out too soon. Being too early is as painful as being late.
Fascinating sort of explanation of what a bubble could look like, and put a time frame on it. Well, we're still far away from it.
Hopefully, yes.
So let's let the party last. Thanks, Neeraj, for that. It's an interesting insight. Coal India today is the top nifty gainer after the mining giant hiked coal prices for the first time in more than a year and a half. Nikki is standing by to tell us the quantum of the hike and the impact this is likely to have on Coal India's financials. Nikki.
Coal India has hiked the FSA coal price by 125 per ton with immediate effect, and this is expected to bring in incremental revenue of around 1,900 crore for the company for the balance half of the fiscal year, and around 6,000 odd crore for overall every year. So also in indirect price hike, the company introduced an evacuation charge by ₹50 per ton. Now, if you look at this, the current price hike is almost 8.5% of your overall FY17 revenues, which stand to the tune of 75,466. This more than covers in fact the higher salaries. Now remember, the company agreed to pay to its non-executive workers retroactively from June 2016, and this was to the tune of around 5,667 per year that it announced back in October 2017 filings. If you look at this table here, which says that additional revenue per year, that is to the sum of around 8,900 crore, And if you look at the additional revenue for the remaining months of the financial year, it's 2,756 crore. That's a combination of both your direct hike, which have been taken, the thermal coal price hike that have been taken today, and also your indirect price hike, which happened back in December 2017. Now, brokerages are all upbeat on this hike. Motilal says that the EPS is expected to increase by ₹7 per or 8 per share with this hike. It already has a buy rating and a potential upside and target price of 335. IIFL says this will drive an earning upgrade of 12%. IDFC too has upgraded the counter to outperform from underperform. If you look at the stock returns, it's a 14% jump that we're looking in for a week. And the players, notably the players that are going to be impacted are the sponge iron ore players here. Something in the like of Prakash Industries, Tata Sponge and Godavari Power and Ispat Limited. And also the non-ferrous players, that is Vedanta, Hindalco and Nalco. They will also stand to be impacted by the coal hike price that have been undertaken.
All right, Nikki, thanks so much for those details. Let's get in another voice on this story. Has implications for a number of sectors. We've got Ashish Nainan, steel sector specialist at Care Ratings, joining us on the phone line. Ashish, good afternoon. Thanks so much for taking our call. What do you make of this hike? It's come after a while. Can you run us through the kind of implications we would likely see on the steel sector and their margins?
So yeah, more on the steel sector, I think they are more of the captive power users. So I think on the expenditure side, they will be seeing another 1 to 2% drag due to this because the coal prices have been hiked by 9%. And this comes on the back of another evacuation charge that they had levied sometime in December, which came to around 50 rupees. So I think the overall hike on coal has been in the range of 12-13%. So this definitely would have some impact on the expenditure side here.
Ashish, what's going on with coal prices globally? You know, you're seeing coking coal prices go up as well. Is this the upcycle for coal globally?
So yeah, globally the prices have hiked up quite a bit. I think coking coal prices have been at a all-time high sometime in the recent past. So I think this is more on the non-coking or thermal side. So this would have a larger impact on power, the extensive sectors like cement or sugar or steel, fertilizer, aluminum, textiles. So definitely this is going to maybe a drag on the expenditure side. Otherwise, I think coal is at an all-time high in the global scenario, yes.
What's the impact on downstream companies? You know, Ira asked you about steel. If iron ore prices are going up and if coking coal prices are going up, isn't that inevitable that steel prices too would go up, or is that too simplistic?
Yes, definitely. It has to be. It has to go up because I think if like 20% of your prices, the cost go into electricity, definitely a hike of 10 to 12% would mean you have to pass it on to your customers at some point or the other.
Ashish, I mean, was this anticipated? I'm just wondering whether companies at the other end would have factored in a higher coal price over the course of this year, or has this sort of come out of the blue?
No, I think this would have been anticipated because sometime back in October, Coal India had signed a wage hike. So they were expecting somewhere around 6,000 outgo towards the wage hike. So the markets must have anticipated it. Otherwise, yes, they have more. It was anticipated that the price of coal had to go up somewhere or the other, given the global coal price movements.
What is your assessment of demand at this point? Despite this hike in prices, do you expect demand to continue to be robust?
Yes, demand is expected to continue to be robust because even the production and demand on the steel and other sectors are also it is seen well. And even the power sector has been doing considerably well during the last 3 to 4 months. We expect the demand to continue.
Are they being able to meet the increased demand? There was a little bit of back and forth about a month and a half, 2 months back, where some of these power companies were saying that they weren't getting the required coal, but then the Coal India guys said that they were the ones who were running short on inventories. Any sense of whether Coal India is running on target in terms of production?
I think, more or less there has been slippage of around 5%, but they should be able to meet their yearly targets more or less in the end. So, yes.
All right, Ashish, we'll leave it there. Thank you so much for joining us. Ashish Nainan from Care Ratings talking about Coal India, impact of the price hike that Coal India has done on the steel sector and what this means for global coal prices and steel demand here as well. Back home, Tata Motors is the second best performer on the Nifty today after Jaguar Land Rover reported its highest ever annual sales in 2017. The car giant is not too gung-ho about its home market though, citing subdued consumer sentiment and higher taxes on diesel vehicles. How big is the UK market for JLR, and can it outdo others despite these challenges? Yatin is standing by with some numbers and a breakup of what this demand has been. Yatin.
Thanks for that, Harsha. And let me take you through the December numbers. If you look at the December sales data, the total December sales for JLR, which is the global retail sales, are marginally up by nearly 0.6% on a year-on-year basis. But look at the UK markets. The total December UK sales were down 16% and the European sales were down 5%. And if you were to believe the industry body forecast, they expect a 4 to 5% decline in car sales for 2018 as well. Of course, they blame it on falling consumer sentiment as well as business sentiment because of Brexit and various other reasons. And not only that, we have the rising interest rates and the government crackdown on diesel cars impacting the overall sentiment as well. But if you look at the historical way how UK has performed for JLR, despite the industry contracting, in 2017, JLR has been able to deliver better than industry growth for both UK and European markets. Of course, on a year-on-year basis, the sales are flat due to multiple reasons, including the phasing out of old models. December traditionally is a weaker month, and from January onwards, we could have newer models that could boost the overall sales. In fact, Nomura says that moving forward, the volumes will improve on the back of new variants, and also the new Velar launch will be something which will give an uptick to the JLR volumes in key markets like UK as well as Europe. Now, if you talk about the geographical breakup, clearly UK as well as Europe form close to 41% of total sales, which is based on last 12 months data. Of course, China has been growing in double digits, but clearly at this point in time, and the pie chart is on the screen, and you could make out how China has been able to grow significantly as a region for Jaguar Land Rover. So probably UK and Europe might be slower, but on the back of new launches, that is expected to pick up. And not only that, China and US markets, because of the strong growth and demand there, could see some improvement in the calendar year 2018, and probably because of that, the stock is quite buoyant in trade, despite the fact that we have the European sales data which is weak for GLR.
All right, thanks so much for that, Yatin. We're just going to quickly take a detour away from business news, come back to it in a minute. But news coming in from Delhi, movie hall owners now have the option of choosing not to play the national anthem. The Supreme Court has today passed an interim order after the government said it's appointed a committee to look into the matter. Arpan Chaturvedi joining us with the details on the phone line. Arpan, what is the outcome?
That's right. That's the background of the case. If we can take you back, is the last year when the Supreme Court had passed an interim order in a PIL saying that it will be mandatory for cinema hall owners to play national anthem before the movie starts. That order, if you remember, had sparked a public debate to the extent that in the last hearing in this matter, one of the judges on the bench, Justice Chandrachud himself, had also made pretty strong observations on as far as the national anthem order was concerned of the Supreme Court. After that, the government yesterday had submitted an affidavit in the court where they informed that a 12-member interministerial committee will look into not just this issue of national anthem in cinema halls, but the guidelines surrounding on the issue of playing, where it should be played, and what should be the decorum followed. And till then, the government had said that the Supreme Court should requested the court to vacate that order and modify that order. Post that, when the hearing came up today, the Attorney General again made the same submission. Post that, the Supreme Court said that the order which said that cinema hall owners shall play the national anthem, that should be read as they may play the national anthem. In effect, making this the playing of national anthem in cinema halls an option for the hall owners and not mandatory. That's the change that has come by the Supreme Court's order.
Arpan, thank you so much for that. That's the view from the Supreme Court in New Delhi. The Telecom Commission meets today to discuss a relief package for the sector. The interministerial group has already submitted its proposal to bail out the sector, which has seen intense competition for the past 15 months or so. Ahmad is here with a list of recommendations that could come up for discussion today. Ahmad.
of the 4 discussions that will be done in the meeting today, the first one and the one that will be keenly watched is extending the spectrum payment period to 16 years. Now, currently the rule is that the telecom companies need to pay 50% of the spectrum cost upfront, then they get a 2 years moratorium period. Post that, the balance 50% needs to be paid in the next 10 years. So the telecom companies want this 10 years to be extended to 16 years. The sector currently has close to 2.9 lakh crore rupees of deferred spectrum liability, of which Vodafone, Airtel and Idea own the majority portion. Now, this extension of timeline will increase the cash flows of the telecom companies and help them manage their capital expenditure in a better way. It will also reduce the liability burden because they will have an extended time period to pay the liability that they currently hold in their books. The second that is important and announcement that is expected to come in is the lower interest rate charged on penalties. Now, currently the interest rate charged on penalties is on prime lending rate, and they wanted to shift to MCLR. Currently, the SBI benchmark prime lending rate is at 13.7%, while the MCLR is at 7.9%. So if this happens, we can see some interest cost benefit coming in for the telecom companies. Third is the proposal to relax the spectrum cap. Now, they want to relax the spectrum cap on the overall holdings to 35% from current 25%, and they also want to remove the band-wise spectrum cap. Now, currently, according to the merger and acquisition guidelines, a telecom company cannot hold more than 25% on the overall bands and circles, 25% of the total spectrum hold over bands and circles, and when you see band-wise and circle-wise, they cannot hold more than 50% of the spectrum. Now, if this comes in, it is a big benefit for the Vodafone Idea merger, as the merged entity breaches the 50% cap in 5 circles and in 2 bands. Now, in 900 megahertz band, the merged entity has excess spectrum in Maharashtra, Gujarat, Kerala, Haryana and Uttar Pradesh West, and in 2500 megahertz spectrum, they have excess spectrum in Maharashtra and Gujarat. Now, the value of this spectrum is close to 6,000 to 7,000 crore rupees, and this is according to multiple brokerage reports. So if this happens, it is a substantial benefit that will come in the books of Vodafone and Idea. Lastly, 100% FDI in the telecom sector. Now, this will be beneficial if we see new foreign investments coming in the sector going forward.
All right, so Ahmad, thanks so much for that. That's the telecom sector and the relief measures expected. In a bid to protect the domestic solar industry, the Finance Ministry has proposed 70% duty on imported solar cells. Anindya Upadhyay of Bloomberg News joins us with more. Remember, Anindya had reported this last week on the possibility of such a duty. But the quantum, Anindya, seems to be larger.
Hi, yes. Actually, there is in a lot of ways, the government is trying to protect the domestic solar industry. So on one hand, the government has been planning a 7.5% import duty on solar equipment by reclassifying solar panels as motors because they generate current. On the other hand, today, the Finance Ministry put up a document saying that, there's a proposal to apply 70% duty on solar imports from China and Malaysia. And, this is interesting because India is the largest importer of, is China's largest, customer for solar equipment. And the Finance Ministry has cited threat of serious injury to the domestic industry as well as potential job losses in taking such a decision. There's going to be a public hearing, and then a final decision would be taken on what kind of, what amount of safeguard duty would be imposed on solar cells and panels imported from China and Malaysia. It has been recommended that it would be imposed for 200 days to begin with. And the document says that the existing critical circumstances justify the immediate imposition of a provisional safeguard duty in order to save the domestic industry from further serious injury, which would be difficult to repair if the application of the recommended safeguard measure is delayed. And now this is detrimental. This could be detrimental for Prime Minister Narendra Modi's solar target, because all the low tariffs, all the record low tariffs that India has seen in 2017 has been thanks to cheap Chinese solar imports. And now with the 70% duty, that could completely change. and India imports about 85% of all its requirements for solar industry, and only 15% is what is homegrown or domestically manufactured. And it also puts a question mark on how is India going to fulfill its requirements if everything gets so expensive. Also, if this duty, it is now only proposed, but if it comes really soon, then all the projects that are under commissioning, under construction, awarded, they will be in serious trouble because the project economics will just go for a toss, and that is the concern of most project developers I spoke with today after this proposal was announced. Back to you.
Anindra, thank you so much for that. That's the development in the solar industry and the impact that this is going to have for domestic players and for power tariffs. Maharashtra government, meanwhile, has a novel idea to deal with housing crunch in Mumbai. The state government has now allowed developers to build affordable houses on unused industrial land. The aim is to build more homes under the Prime Minister's urban housing scheme. Purva Chitnis is standing by with some details. Purva.
Yes, now there will be more land available for housing in Maharashtra. The state government has taken this decision to unlock the old and unused industrial land parcels within cities for real estate to boost the affordable housing scheme. As per the decision, about 20% of this land is reserved for the EWS and LIG section, where houses would be sold by Mahara under the lottery system. The industry believes that this is a very good move which can boost the affordable housing within the city limits. However, the town planners are not really happy because they believe that this requires proper planning, and unless the planning is done, this could already congest the already congested cities. So they believe when there is already a pile-up of inventory which is lying in the MMR region, there was no need for such a kind of move. However, they believe that if the proper planning is done, this could prove a brilliant move.
All right, decision taken by the government. Not everybody convinced it's the right decision. Moving on, the battle for dominance between Amazon and Flipkart has opened the doors for one of India's largest logistics companies to reinvent itself. All Cargo Logistics, which was traditionally a port-based logistic company, plans to transform into a B2C company with a specific focus on e-commerce. Dhwani Pandey of Bloomberg News joining us with more details. Dhwani, what have you picked up from the company?
Hi. So, in a conversation with the Shashikiran Shetty, the chairman, he basically gave us an idea how the company plans to reinvent itself. They are building warehouses across India, mother hub warehouses, as well as they are planning to acquire technology-driven logistic companies so that they can serve likes of Amazon and Flipkart and give last-mile delivery.
What's the game plan? I mean, building warehouses is one. Isn't this an entirely different ballgame? Aren't there already existing logistics players in this space?
Absolutely right. If you see, KPMG had come up with a report that, around 20% traditional logistic service providers are there in the entire game, whereas 50% are e-commerce focused players. So it will be very difficult for All Cargo, which is, typical brick and mortar kind of a setup. What they are planning is they are planning to hire new people, young generation people. At the same time, they are planning very technology-driven logistic acquisitions to transform themselves into this last-mile delivery providing company.
Sure. Any numbers of investments or any targets?
Sure. So they have around 300 acres of land across 4-5 cities, and they plan to invest 7 to 10 billion rupees over the next 4 to 5 years. To develop these warehouses and last-mile delivery logistics services.
Dhwani, thank you for that. That's all cargo for you. That stock, bring that up on your screen. That's marginally lower, but trading at about 222. The world's busiest air route is in London or to Paris or New York to Los Angeles, but the trip between Seoul and a tiny island off the coast of South Korea. Planes made 65,000 trips between the Korean capital and Jeju Island, a journey of little more than an hour in 2017. This amounts to about 178 flights a day, according to data from OAG Aviation Worldwide. That's almost double the 35,000 trips on the business North American route of Los Angeles to San Francisco. Asian cities also dominated that list, cementing the region's status as the world's fastest growing travel market. India, for instance, features third on that list, with 47,500 trips between Mumbai and Delhi, among the 10 busiest in the world. Last year, Los Angeles, San Francisco was the only North American entry, and there wasn't a single European destination. The top European routes in the rankings was Dublin to London Heathrow with about 14,500 flights.
Right, interesting data there. Let's slip into a quick break. We'll come back on the other side, talk about the North Korean, South Korean meet that's coming up.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
More than just business news, we're news for business people.
Welcome back. You're watching Power Lunch. Let's dip back into the headlines. Indian markets taking a breather as investors gear up for the third quarter earnings season.
Coal India is the top gainer on the Nifty after the mining giant hikes coal prices for the first time in 18 months.
During the first formal talks between the rivals in more than 2 years, Seoul proposed athletes from the two Korean nations march together at the opening ceremony and engage in other joint activities during the Games.
All right, let's do a quick check on how the markets are faring at this point. And Pradeep has been taking a closer look at some of those movers in the last half hour. Pradeep.
So what we were in fact anticipating, yesterday that there could be a brief correction at least in the markets because markets have gone up quite a bit. So the targets that you were expecting for the whole week were actually achieved in a hurry. So that could be a reason why there is some kind of a cool off in select sectors like IT that went up, or you had certain mid-cap stocks that had gained quite a bit. Some paper stocks, for example, had moved up. Then you had carbon black shares like Philips Carbon Black moving up. So these are the prominent stocks that are correcting. Also, Jet Airways you could add in the list. What traders believe that a 50 to 70 point correction is not unusual after a consistent move for 6th day in Nifty, actually for 3rd or 4th day in Nifty Bank. So that is what we are exactly witnessing. But there are several pockets, like you mentioned, Coal India, which has been holding on. And then in the mid-cap space also, if you look at the high beta sectors like real estate are actually have been participating in the up move. So it doesn't look like traders are short of options at this point of time. Then you have some traders' favorite names like NCC doing well. Arvind moved up quite a bit. And even in broader market, there is some bit of churn, and several stocks that were probably consolidating for a while, like Quick Heal, for example, have started moving up. There are different developments or news flows, of course, that is really driving these stocks. But net looks like, yes, a breather. Will it turn into a correction that will last for a day or two? I think it's too early to say, but this cool off will definitely give an opportunity for long traders to get in today, tomorrow, or maybe they have to wait for 2 or 3 days.
All right, Pradeep, thanks so much. That's the markets halfway through the show. India's record-breaking rally may not be done yet. At least that's the word coming from Mahesh Patil of Aditya Birla Sun Life Asset Management. Patil expects low-teen returns this year, boosted by earnings, economic growth, and renewed interest from both domestic and global funds. Amir Karve of Bloomberg News joins us with the key takeaways from that chart. Amir.
Yeah, so basically what he's saying is, there are stocks like, banks, public sector banks and corporate lenders. They have a very low base of earnings, so they are going to rebound. That is going to be the prime drivers for the earnings. And on the other hand, IT, pharma, these are the stocks that will rebound, and that will be the key driver for earnings. And on the economic front, he says that the pain of the reforms is well behind us. That is what he says. And probably the recovery will be there, and that will also make the mood buoyant.
Specifically on earnings growth, the estimate seems to be on the extremely high side. If you look at that chart on your screen, close to 25% if I'm wrong in terms of overall Nifty earnings. Any color on why they're so bullish?
Yeah, that's what I mean. This is, if you can see, this is the steepest estimate. I mean, the estimated thing is the steepest in 9 years. So investors are saying that for a long time we didn't have an earnings rebound of this kind of growth. So this is the factor that by the way, the Patil has a lesser estimate than this. He has a 19% earnings factor. So more or less people are adhering to that view that 19-20% kind of earnings growth will be good enough for the markets. They're happy with anywhere between 15 to 20% growth because we haven't seen this growth for a long time.
Any view on fund flows, Ahmad?
Fund flows, he says, will continue. I mean, because domestic, the story that plays on is, there are no real options. Like, government has increased the scrutiny for speculators in gold and property. So there's no option. I mean, fixed deposit rates are falling. So equity is the only option. And on the foreign front, he says that, Patil says that as the economy recovers, because they play macro. So as the economy recovers and the earnings come back, even he expects the foreign flows to be buoyant this year. So combination of these both definitely is going to be, on the liquidity front, no issue on it.
Has he given you any tangible targets on the Nifty?
No, he doesn't give targets, but the returns itself can be, you can calculate that. So when he says low teen, you can calculate the targets.
Ahmad, thank you so much for that.
Thank you.
All right, let's move on to the crude markets. After making a strong start for the new year, crude oil has extended its gains into yet another week. Prices hovering near 2.5-year highs, actually. Let's discuss what the outlook for the crude markets is. Azlin, the editor of crude oil markets at Argus Media, joining us on the phone line from Singapore. Azlin, good afternoon. Thanks so much for taking our call. Azlin, what have been the factors at play in the last week or so on the crude markets which have kept prices elevated?
Well, I think that one of the things that has kept prices high is just the concerns about the Iran situation, just a protest in Iran. And so far, it has not affected any production. But obviously, Iran being a big OPEC producer, it's something that the market will watch very closely. The data also shows that the OPEC compliance in December was very high. It was total for OPEC compliance to the output cuts was, I think, more than 150%. So that really gave the market a bit of confidence that the OPEC and non-OPEC producers are serious about keeping their production low so that prices don't fall. So I think those are some of the big factors that kept prices well above $60 for Brent.
What about US inventories, Azlin? Is that sort of counterbalancing force for the market right now?
Well, the U.S. crude inventories have been falling for the past 5 to 6 weeks. So that has also helped, keep prices high. But with the U.S., production continues to rise. And there's always the danger that if oil prices really shoot even higher, that there will be more incentive for the U.S. producers to increase production even more. So that will always probably put a bit of ceiling on oil prices because, and the higher oil prices are, the more that U.S. producers will probably want to increase their output.
Brent is currently trading at about 68.5. When you speak to market analysts, what's the sense that you get? Is this going to be at these levels at least for the next couple of months?
Well, our view is that overall, on average, we do see that Brent will be a lot lower than where it is now, and that we do see the average for ICE Brent in the first half of 2018 around $60 or just slightly under $60 per barrel. And the reason for that is first quarter is usually typically when crude stocks start to rise. So we'll have to see what happens. There's been some output disruption in the last month with the 40 and temporary Libyan pipeline closure because of an explosion. So those were also factors that I think pushed prices significantly higher. But once all those factors are resolved and production comes back to normal, I think that we're going to see prices start to ease off from these high levels that we are seeing right now.
Azlin, what is the range that you're hearing from people you speak to, traders, etc.? Even on the downside, I know currently we're only talking on the upside, but for 2018, what are the kind of numbers that people are talking about, both Brent and WTI?
Well, I don't think at the moment people are not so much looking at the downside. Basically, but it all hinges, I think, in terms of the downside, it hinges on the OPEC compliance, because the OPEC compliance in 2017, OPEC and non-OPEC led by Russia, was actually very high and much higher than the market had expected. Now, assuming that this continues at least into first half 2018, we should not see prices fall below $50 for ICE Brent. I think that if we see the cheaping between among the producers that are part of the producer output cut agreement, then there is a prospect of oil prices falling. But we don't have at the moment a floor for prices. But I think it all will depend on what OPEC and non-OPEC does in terms of the maintaining their output cuts.
Azlin, we leave it there. Thank you so much, Anil, for joining us. Azlin Ahmad talking about oil prices. Brent is trading at about 60, 68.5. And market seems to be relatively bullish on where the prices are headed. WTI is at about just over 62. Meanwhile, North and South Korean officials met for the first time today in 2 years. The neighbors who have had a frosty relationship, to say the least, a month before the Winter Olympics takes place in South Korea. That's an event where Kim Jong-un is expected to send a delegation. Stephen Engel of Bloomberg News, who's been tracking this historic meet, sent this report to us just a short while ago from Panmunjom.
The prevailing mood obviously would be of optimism, because they came to an agreement fairly quickly, at least in the morning session, on allowing the North Koreans to participate in the Winter Games, which open 1 month from today in nearby Pyeongchang, South Korea. They would potentially march together at the opening, and also the North Koreans would send a high-level delegation to the Olympic Games, as well as athletes. We do know at least two athletes, two figure skaters, have qualified for the Winter Olympics, so they could potentially be either incorporated into the South Korean team, have a unified Korean team. We're not necessarily sure. But the mood going into the afternoon session, at least from the dribblings we get from the officials through the press pool, is that they're fairly optimistic to go into the smaller group meetings to nail down some of the fine details, because it's just a month to go before the games. Some of the other issues, though, again, the denuclearization of the Korean Peninsula, that's going to be the big bugaboo, because it was on the list of proposals. The South Koreans want to restart talks on denuclearizing the Korean Peninsula, or definitely in the north. However, the North Koreans reportedly remained fairly quiet when that issue was brought up in those talks, which are happening just down the road here, across the bridge, about 5 miles from here.
All right, some positive news emerging from the Korean Peninsula. Jeff Bezos is now worth more than Bill Gates ever was. Jeff Bezos' net worth has reached $105 billion on the Bloomberg Billionaires Index, as Amazon's shares added to a 12-month surge that lifted the online shopping giant's market value by almost 57%. This makes the Amazon founder richer than Bill Gates has ever been, even when he held a lot more stake in Microsoft.
On that note, is out of time on the show. Thank you so much for joining us.
Countdown is up next.